Let's talk money. Let's do it. Let's talk finance and basics. And I want to make this exceedingly simple for us here. So, this is money. It's actually, to me, a particularly exciting stack of hundreds. So, let's call this $3,000. If you go out and spend money from this pile of money that you have, then you are left with fewer $100 bills. Or if these were ones, or if these were billions, like whatever. But the point is, if you're spending these, then you have less. All right, pretty simple idea. If you say, okay, I'm going to spend a little less, then that's called saving, or spend reduction. There's lots of different ways that you can consider this from a budget or a finance standpoint, but the point is you retain more than you otherwise would have. That's cool. If you say, hey, I'm going to earn more money, now you have more money overall. Here's the nature of investing, though. Let's put back our expense money, and let's say, okay, here is our nice stack of $3,000 bills. You go out and you become a trader, not like a traitor who stabs people in the back and does what is wrong. Do you see how Benjamin is staring at us? Benjamin! Benjamin! Why do you look so scorned? All right, you're going to be a trader, a trader. You're going to say, let me deploy these Benjamins to buy an asset that is undervalued. And that asset that you purchased for $3,000, you later sell for $6,000. Boom. Okay, so now you have your original $3,000, and then you have $6,000. That is the nature of trading. You bought something for $3,000 that you later sold to return your principal. This is your principal, your first amount of money, and then gain. You can call it interest, you can call it profit. In this case, it would be profit. So now you have $6,000. That is your new principal amount. Let's say you take $6,000 and you go buy an asset that later returns $6,000 more. Now you have $12,000. So this idea is that you invest principal, it returns profit. Now you have a new principal amount of more that you can deploy, and you can get more profit, and it all stacks up nicely. Now, here is a key difference between investing and speculating. If I was to go out and say, I'm going to take this $100, and I'm going to say that the market may take this $100 and put it into, let's say, CBD stocks or whatever. The market may do this, so I'm going to put this $100 at work, and I stand to gain wild amounts. So turning 100 into 1,000, that's a 10x return in 6 months, say, or a year. 10x return, that's a 1,000% return, I think. Check my math. That is saying I'm going to put my principal, or I'm going to bet on what the market may do. I'm going to speculate on what the market may do so that I can gain a wild amount of money, a much higher return on investment than the market is safely willing to produce. That's the idea of speculation. You can produce some wild earnings, but it is not investing. What's investing? Investing says, I see what the market's doing over here. I see it, and I'm going to participate in this. Okay, I understand that Benjamin here will be subject to what the market is willing to return. What is the market willing to return? Okay, well, the market is willing to return 10% for this investment. I'm seeing what the market is doing, and I'm choosing to participate with that to achieve a gain. And where investing typically gets very exciting is over time, when the years stack up, and they stack up, and they stack up. But if you'll notice, this 10-year horizon, say, to 4x your money, is not nearly as exciting as that speculative push that we looked at earlier, where you could 10x your money in a year. But the nature of it is, this principle is kept relatively safe. This principle is subject to the normal market risk. So inherent with any investment is risk. Inherent in owning a home is risk. Inherent in owning a vehicle is risk. Inherent in owning anything or investing in anything is a set of risk factors that is normal for that investment. But it's a knowable risk and a relatively knowable return. And so your principal is kept safe and it earns. Versus speculation, as is the nature of speculation, is the risk is not calculable because it's not known, because it is, at the end of the day, it's speculating. It's saying, here's what the market may do. And if we could truly predict or know what the market may do, the world would not look as it does. And in the end, we would not be the same way that we are. So that's a basic look at money, specifically the difference in principal and profit, speculating and investing. Have fun, and let's make Benjamin proud.